Good morning. Welcome to Stock Market Today. It's Wednesday, November 20th, 2019. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email giving you daily stock ideas to consider in your inbox every trading day before the market opens. So U.S. equities were mixed in Tuesday's trading. Energy and consumer discretionary were under pressure on weak oil and disappointing retail earnings. Healthcare was the best performer with biotech strong. Treasuries were little changed on the day. The dollar was weaker versus the yen and the euro. Gold finished up 20 basis points. WTI crude closed down 3%, near the worst levels of the day. So your outperforming sectors, healthcare, tech, REITs, underperformers, energy, discretionary, consumer discretionary, and materials. As we get to the desk this morning, futures are down a bit, down about 20 basis points off the worst levels of the day. Some commentary overnight regarding the U.S. and China. Asian markets were lower, with Australia and Hong Kong the big decliners. European markets are weaker as well. Treasuries are stronger with the curve flattening. Dollar is slightly weaker versus the yen, but stronger on the euro cross. Gold is up 10 basis points. WTI crude is up 20 basis points after falling more than 3% yesterday. And as we dig in here now and look at the structure of the market, we're still trading near all-time highs, but we are overbought with very bullish sentiment. We'll take a look at what both of those things mean in just a little bit. The key support area, still at the 200-day moving average, creeping up now to around 29.15. In the near term, 30.30 to 30.50 are the levels that we really want to watch closely. Then below that, 29.50, we've gone through what those levels mean and why they're there numerous times over the past couple of weeks. Here's the first leg of the stool. RSI is now overbought. It's been overbought for a few days. That RSI reading here at 73 is in the overbought territory. We haven't been overbought really since the spring. Chaikin money flow is still bullish, down ticked a little bit yesterday. But we have overbought markets with really frothy sentiment. I guess that's the key takeaway from today. What does that mean? It means we just kind of pay attention. Pay attention to what's going on. As always, we're selective with our thoughts and ideas, focus on leading areas of the market, and manage your risk. Now, futures are under a little bit of pressure here this morning off of those headlines, and we will dig into that in just a second. Market in a minute. Quiet session yesterday as SPY Churns near the all-time highs. So what happened overnight was the Senate passed a bill in support of Hong Kong protesters, and that led to warnings by China of potential countermeasures. And that is what's weighing on global equities here this morning. As I said, sentiment remains more greedy than fearful, and futures do point to a lower open here today. Looking at the power bars now for the major indices. Dow was down 34 basis points yesterday. Still 2-to-1 bears to bulls on the power bar ratio there. 8 bearish or very bearish stocks for 4 bullish or very bullish stocks. S&P 500, call it relatively flat. 131 bulls to 86 bears. NASDAQ outperformed, tech continuing to do well. Q's at a new all-time high yesterday. 34 bulls to 18 bears. Small caps had a decent day yesterday. Up 40 basis points on the day, 683 to 306. So much better than 2-to-1 bulls to bears for small caps as they are pushing on the string of resistance at the $160 level. According to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish. The major indexes across the board, however, are mixed, given the Dow is throwing a little bit of a wrench in the works from a power bar perspective. But again, the trends that we've been highlighting do remain in place. Wouldn't be surprised to see a little bit of near-term backing and filling here. Let's hit our stock of the day now. Applied Materials, semiconductor capital equipment company, closed at 60.94 yesterday, down 2.25%. AMAT has a very bullish Chaikin power gauge rating due to very strong earnings performance, very positive expert activity, as well as strong price volume activity. 20 factors, 5 in each of these 4 categories give us our very bullish rating. Strong trend, strong industry group. Stock is above a rising long-term trend line. And anybody who's been a listener to this show, watcher of this show, knows that semis have been strong and we've been bullish on them. AMAT has actually been one of our best ideas. We've liked the stock since it was back down around these levels on this pullback here after the rating turned bullish. So nice pop higher following earnings, seeing a little bit of a consolidation there, but let's run through the process. AMAT is a very bullish stock that is outperforming the market. The market and model are in agreement. Chaikin money flow, bullish, steady uptrend. Basically has everything that we are looking for in a bullish idea. However, timing, probably not the best. We are overbought here. We're in market a little bit heavy here this morning. AMAT is overbought. I think we want to look for a consolidation around this $60 level to work off these overbought conditions to set up a better entry, all else being equal, meaning it's still very bullish, or bullish, meaning it's still outperforming, and money flow has been persistently bullish. AMAT's been a name that we like. We've liked semis. You've heard us talk about them a lot. I just don't want to chase here. I don't see the need to chase AMAT into this overbought condition for the time being. Let's look at our sector tracker now. Movement of the major sectors over the last 5 days has a little bit of a defensive feel to it of late. Market's been churning near all-time highs. Rates have kind of come in a bit, and that has helped real estate and utilities, 2 out of the top 3 sectors. Healthcare. Healthcare is kind of interesting. We're going to take a look at the healthcare sector a little bit later on in the show because we are starting to see some a relative pulse, if you will, in healthcare. So something that I'm writing about in my note today to Chaikin Analytics clients. Middle of the road, comms, tech, and staples. Financials and industrials are higher over the last 5 days, but only marginally so. Discretionary under pressure yesterday. Materials and energy towards the bottom of the list. Remember what we've been talking about in energy here. Fundamentals just not there. We've looked at it. We've beaten that horse. And fundamentals are just not there in energy. So rallies are not really a reason to get excited. So started to get some questions a couple weeks ago. Energy looked like it was perking up. People were asking me, what would it take for me to turn bullish on energy? Well, our model would have to turn bullish. The fundamentals on the underlying companies would have to start getting better, and we're just not seeing that. 2 different times in the past few days, we've pointed that out on this show here. Now, our industry in focus, however, is one that we do like. Regional bank services. Over the past 6 months, it's been an underperformer, down by about 2.5% relative to the S&P 500, but the power bar ratio measures future potential is very strong. 74 bullish or very bullish stocks for only 2 bearish or very bearish stocks earns it a rank of number 2 of the 21 subsectors that we look at. So some of the indicative names there that we might want to pay attention to, look for opportunities should they present themselves. QCR Holdings, very bullish stock. First Foundation, FFWM, very bullish stock. And East West Bancorp, EWBC, also a very bullish stock in Chaikin Analytics. And let's take a look at the model here. Let's take a look at KRE, the ETF that tracks the regional banks. First thing that should jump out of us is the very bullish rating. We have a strong trend above the rising long-term trend line. Now, in fairness, this is choppy. It's been choppy for a year. We're pushing up near the highs here. It's been a tough spot. We haven't really been able to get through this $56, $57 level with any kind of conviction. However, look at what's changed. Previous attempts to break through $57, the group was still underperforming the market. Now look at the personality change here on relative strength. Fund is now outperforming. So we have a very bullish ETF outperforming the market, bullish money flow becoming oversold. For those of you who look for opportunities in the ETF landscape, I think you want to be paying attention to KRE. Now remember, this is going to be interest rate sensitive, right? So day-to-day moves in interest rates are going to affect the group, but we're looking at this improving trend in relative strength that's really piqued our interest. And when we go under the hood and see 74 bullish stocks to 2 bearish stocks, we think that outperformance has a higher probability than normal of continuing, setting up a pretty compelling risk reward. For those of you who want to wait for the breakout, call it $58 is the level that you want to see as a breakout. And for those of you into classical charting, we have a 10-point range here. So a breakthrough 58, target 68 to the upside. But I think you want to be paying attention to the regional banks. Let's look at what's trending now. Yesterday's S&P 500 movers and shakers, our gainers and losers. You know what we feel about semiconductors. AMD, 52-week high, up 3.5% yesterday. Nothing company specific on the news front, but just that sign of momentum. New highs tend to beget new highs. Abiomed, remember this stock was over here yesterday, down 20%. Gets a 3.5% rebound yesterday. Nothing company specific. Constellation up 3.5% on news that MO, Altria, is adding to their position in Chronos. This is a little bit of a cannabis theme here. Remember, Constellation has some exposure to the cannabis theme, so that investment in Chronos took Constellation higher, even though it was completely unrelated. It's more of a thematic trade, up 3.5%. Fox A, media was strong yesterday. Fox A was up over 3%. Market access, no real news to take that hot stock higher by 2.75% yesterday. The loser side of the board begs a mea culpa on my part. No sooner do I come on and highlight the fact that retail has been given a bullish ETF rating at Chaikin Analytics and is beginning to outperform, we get two really disappointing earnings announcements out of the retail space. So my timing there, I give you a mea culpa on my timing. Kohl's, their comps missed, as did margins, caught a couple downgrades today. Stock was down nearly 20% yesterday. Macy's and JW Nordstrom down 10% and 6.25% respectively in sympathy with Kohl's. Home Depot reported a third consecutive comps miss, takes that stock lower by 5.44% yesterday. So as I said, no sooner do I start chirping about retail, and retail gives me a nice kick in the gut, if you will. Now, what I will say this morning is we heard from Lowe's, and that stock is trading higher. We also heard from Target, and that stock is trading higher, so maybe I'll get a little bit of a reprieve. But when I'm wrong or early, I come out and say I was, and that was the case yesterday as I was talking about retail. AT&T down 4%, caught a downgrade to sell from a highly respected media research shop, Moffett-Nathanson. So they took 4% out of the stock yesterday. Let's turn to our charts now. Are investors too bullish? Here's that chart I've been showing you for some time, 13-day moving average of the CBOE equity put-call ratio, and it is now down underneath levels that have tended to mark near-term pauses or even pullbacks rather in the market. So just something to pay attention to. Remember earlier I said the market was overbought and sentiment was really frothy? This is what I'm talking about, right? Sentiment is pretty frothy in the marketplace, and you can see it a few other places as well. CNN Fear Greed Index is at 80, still in a position of extreme greed. The VIX has really come in of late. So signs of complacency in the market. Again, is that your immediate sell signal? No, but you want to pay attention to it. You want to pay attention to what's going on. These shifting dynamics in sentiment should drive or calibrate your level of aggression in the marketplace. Markets had a good run. We've been highlighting a lot of bullish opportunities for our clients. You just want to ride those bullish opportunities and maybe be a little bit more selective with your new ideas given the sentiment levels where they are currently in the marketplace. And that's just how I look at it, right? Sometimes it's just a pause, but sometimes it is a bigger pullback, and it's hard to know. That's why you manage risk. That's why every position that you have on, you should know where you're getting out before you get in. You should have a stop level, and as the stock moves in your favor, you should be moving that stop level up with the uptrend. And then if we do get a rollover, the market will take you out of your positions, and you've now removed emotion from that decision. We do see signs of a relative pulse in healthcare, though, and I am trying to be funny, so hopefully you are laughing. XLV, the Healthcare Select Sector Spider ETF, has broken topside from a consolidation and continuing to move higher. Now, it is overbought in the near term. That's fine. The RSI is over 70. We are above the rising 200-day moving average, and the fund does have a very bullish power gauge ETF rating at Chaikin Analytics. Take a look at the power bar here. 34 bullish or very bullish stocks for only 3 bearish or very bearish stocks. But what's starting to really pique my interest is the broken downtrend on a relative basis. XLV relative to the S&P 500 has now broken this downtrend line. We've seen a lot of charts like this over the past few days. This is the signs of the rotation that are playing out in the marketplace, and we want to try to catch them as early as possible, which is why I've been highlighting them, right? Why we started highlighting the financials and the banks a couple of weeks ago. We're trying to catch these early signs of rotation and see where they could be sustainable. I think healthcare could be one. Now, healthcare is a very broad group, right? There's a difference between, medical devices and healthcare services and biotech and pharma. So I do think you want to take your analysis down to the industry level, right? But it starts from the top down. We have a uptrending market. Let's identify the sectors that are outperforming. Well, healthcare is starting to outperform. Let's now drill down on the individual industry groups within healthcare to find the really higher end stocks, the higher quality stocks that are most likely to continue to outperform. Finally, small cap technology is pulling back. We highlighted this one a couple of weeks ago as it was breaking out. I continue to like it. I think the pullback is going to provide an opportunity, especially if the RSI holds in bullish ranges. You can see we are holding above relative support. PSCT, the ticker symbol there, very bullish ETF power gauge rating, 41 bulls for 8 bears. I think small cap tech is an interesting sub area of small cap. So while we're waiting for small cap to break out, there are areas within small caps that are already breaking out, and small cap tech is one of them. So take a look there. That'll wrap us for today. Have a great Wednesday, everybody. I will be back here tomorrow. Thanks for taking some time to be with me.